everyone, 5 p.m. on the clock, which means it's time to kickstart Rise with India Prime Time. And as always, we will do so with the Money Show, your one-stop destination for all your money-related matters. This is what we have lined up for you on the show. And this one is dedicated to all the parents out there who have young children, or even for that matter, to be parents. What should you be prepared for? What are all the hidden costs that come along with a child? How should you be financially equipped to fulfill your children's dreams is what we will be talking about today. But it's also that time of the year when your child may be making that decision to go and study abroad. But do you know what sort of costs does that entail when you actually go study abroad? And also, is education loans an option? This is what we have lined up for you on the show. Like I said, it is a parent special more than a children's special, because this usually is the headache for all parents out there. So stay tuned for the course of the next 45 odd minutes. Like I said, today we are going to be discussing all about parenting. Not how to parent, but how to financially plan for parenting, especially for all the new parents out there. Remember, they say it takes a village to raise a child. Well, it also takes a lot of money to raise a child. So what should you be prepared for, and what are all the hidden costs that can come when planning a family? To talk about that, I have with me today on the show Mr. P.V. Subramaniam. He is the CEO of Supramoney.com, and Mr. Subramaniam is joining us right now in the studios itself. Thank you, Mr. Subramaniam, for joining in. This is a factor that does scare a lot of people, and rightly so, right? Like I said, you know, having a child is not an easy task, not just because of the non-financial aspects, but also because of all the financial aspects. So especially for all our parents to be, what should they brace themselves for, apart from, of course, a lot of long sleepless nights?
I'm sure you have a lot of friends who have a kid, and none of them is planning for the second kid. Because what happens is, by the time they go to seek admission for the first kid, they realize the cost of schooling is so high that the second kid to banta hi nahi. So the fact is, like everything else, you've been hit by inflation in education also, and pretty dramatically. Compared to what your parents spent on your education, throughout your education, you'd spend more than that on first year of schooling. Right? That's the kind of expense which you will incur right from schooling, college, and an MBA abroad or whatever. All those things are going to cost you a lot of money. And apart from education, you have kids buying gadgets and things like that. So yeah, it's expensive having kids. So if you are having a kid, you have to be prepared for a lot of those expenses. Like you said, sleepless nights, which means you'll have more domestic help. Maybe a parent moves into the house to help you. So there could be cost of their travel and their stay, etc. Then you could have costs, you could have a 6-month chutti, which means you could be on half salary, quarter salary, or things like that.
Almost
or you could take
salary as well.
Almost no salary, or you may take a 3-year break, and which means a pretty long break, right? So it's a temporary retirement, I would say. For 3 years, if you're not going to earn income, then you're going to slack in your job, and you're going to lose some. So all those costs put together, it's pretty expensive having a kid. So it's an irreversible decision, right? You cannot do anything. If you had a kid, you had a kid.
Right.
If you got it right, it's a 20-year project. And if you got it wrong, it's a lifetime project. You're going to look after the kid for the rest of your life. And kids do very funny things. They get educated in one particular area. They can't get a job. Then I'm seeing 28, 29-year-olds who have still not earned a rupee in their life, which means they're dependent on their parents. You have to think of all these things, see what can happen, see what won't happen. It's your DNA after all. So will the kid be as irresponsible? You have to find out all that. I mean, afterwards, it's just a guesswork. So yeah, it's expensive.
So I don't know if we've really managed to spook all those new parents out there. But hey, don't stress. I'm sure all the happy moments as well. I think we'll have to give a disclaimer at the end of this show, Mr. Subramaniam. But okay, you know, of course, like we say, expenses are unending. So the only way to be able to meet that is by making a lot of money. And of course, whatever money you do have, by investing it wisely. Now, of course, the market always throws up all kinds of opportunities. But now, especially now, you have all these complex instruments and products the most common way when, parents think of how to secure the future of their children is insurance. A term insurance or a life insurance, that if something happens to them, the money goes to the children.
Right.
And then, of course, you have mutual funds. So when should you select mutual funds? When should you select insurance? Or should it be a perfect mix of both?
A perfect mix of both, which means what happens is if it's a single parent, or if it's one parent who is earning, or both parents who are earning, then depending on who is earning how much, you need to take appropriate amount of term insurance, right? So the term insurance should then, first of all, there has to be term insurance. Second, there has to be a will saying where the money will go, who will be the caretaker for the kids, and that two people could be different. One person could look after the money, one person could look after the kids. The mother's brother could look after the kids and the father's brother could look after the money. They need not be the same person. So those documentation is to be completed. But term insurance and mutual fund is a more sensible combination than taking an insurance product for the child. That doesn't make so much sense. It is a little inefficient and you may not be able to get rid of it very quickly. If you don't want it, then you'll still have to suffer it for 20, 30 years. That's not a very sensible thing to do. Whereas mutual fund, you can stop, you can restart, all those options are available.
Okay.
So,
there are also these children plans. I mean, a lot of these companies nowadays market it as children plans, and they may essentially just be your regular mutual funds, but at least that's how it's marketed. But Mr. Subramaniam, do you agree with that, or do you think these children plans actually do serve their purpose of the name?
No, see, what happens is, for a very smart person who knows how to invest, maybe one or two funds are enough. But a lot of people, if you tell them put money in the funds, they'll say, no, I already have that fund. He may be putting a small amount, he may not want to put more amount. So this sales guy finds it difficult to sell him more of the same product. So he sells him another product, which is a child plan. Do you need a child plan? No. There are other products which will do this work, but it isn't too bad. Taking a child plan isn't too bad, and you can show it to your kid. It will be in the kid's name, you can show it to the kid and say, look, this is your money, it's growing up for you, it is doing this for you. I mean, you can start teaching the kid when the kid is 5 years old and say this money is being accumulated for you, and those kind of things, it helps.
Another very important point is, what should your family know about your own finances? In fact, we don't talk about it very often, but yeah, there are certain, of course, not to very young kids, but at least when the child grows older, maybe above 12 or 13, when they do have a basic understanding. It really helps when they have a ready checklist of all the documents and all the finances that are in their parents' hand. So, let's say when the child is above 12 or maybe above 13, as parents, what should parents make their children aware of in terms of their finances? Okay,
it's ideal that you have something like an investment diary where you write down all the details, right? What you have bought, why it is, and for what purpose that investment has been made, and the kid should know where the document is. So when you're talking money with your financial advisor, take the kid along to the financial advisor and see what he's saying and things like that. Maybe the kid doesn't open his mouth, but he's at least imbibing everything. So if the first time he goes, he was 13, and if something happens to the parents when he's 18, he's reasonably prepared. Not that he's fully prepared, but he's reasonably prepared. He has heard those terms like mutual fund, term insurance, when it pays, what it does. It is very, very important that kids know this. And today books are available which say what a kid should know and things like that. So I think you should be buying those books, sitting with the kid and reading it. So I think that is very useful. In fact, teaching money is far better than just accumulating money. Of course, you will accumulate money, that you have to do, but teaching money is far better than just accumulating money.
How to be financially responsible.
How to be financially. Reading labels is something which you have to teach your kids, whether it is food label or financial product labels. There are just too many products, maybe 5,000 products. You need to say yes only to 5. 4995, you have to say no. Right? You have to say no to a lot of products which are today being hawked to you in the market. You don't need it.
Okay, all right. So, at this point of time, I'd like to keep the floor open for questions. And when I say floor, I'm talking about all our viewers out there who are watching back home in their television. The numbers appearing on the top of your screens, 24990388, or you can call in on, or you can email us rather on themoneyshow@etnow.tv. But please do call in any questions or queries that you may be having. If Mr. Subramaniam has really scared you and you're a new parent, well, it'll be Mr. Subramaniam's job to ease out all that fear. So call in right now and we will kickstart Ask the Money Show. Well, let's just do that first with all those questions and queries that we have received via email. First up, we have Mr. Varun Jain who has sent in a question. He says, and that query will come up for you on your screens in just a bit. He says, I have an 8-year-old daughter and I have heard of the Sukanya Samriddhi scheme, which also leads to a fall in the tax bill. So I have invested the money my daughter has received as gifts from relatives and friends in the same. He's not mentioned the amount. He says, I would still like to put in some more money in the markets for her future. Is this a good scheme or should I invest this additional money somewhere else? Well, it really is a good scheme. I mean, Sukanya Samriddhi scheme,
Sukanya Samriddhi is
returns.
A good scheme. You get ATC tax deduction. But ATC is today very crowded. You have your own PF, you have children's school fees, you've got
and
your...
just 1.5 lakh.
Yeah, and 1.5 lakhs, your home loan repayment. So I wouldn't look at the tax concession as a very big thing. And I would look at Sukanya Samriddhi as one portion of the money. Remember, it is going to give you 8% and that's all. Whereas, because with a kid, if you have a young kid, if you have a 1-year-old, you've got 17, 18 years for the money to grow. So half the amount, if you're going to put away 2 lakhs in a year into Sukanya Samriddhi or 1.5 lakhs for getting a tax break, you're better off putting 75,000 in Sukanya Samriddhi and 75,000 in an ELSS scheme. You could look at a Reliance ELSS or a DSP ELSS and start an SIP there. So do this combination of half debt and half equity. In fact, I would think more equity and less of Sukanya Samriddhi scheme. And later on, closer to 18, which means when the kid is 14 or 15, you remove the money and keep it in a debt scheme so that at 18 when you need it. But at 18, if you don't need it and you need it at 21, then do that removing at 18 instead of removing it at 15. So yeah, do a combination. Little bit of equity and little bit of debt makes sense.
Yeah, because I think the whole advantage is that when you're investing for your child, you have time on your side.
16, 17 years if you have, it can be more
and remember,
equity.
folks, that equity needs time. It's not something that you can withdraw in 2 years, 3 years, 5 years. The longer duration, the better, because that's when you have more return potential. And, you know, with kids, that's always an advantage. Okay, let's take our next question. It's a very interesting one, actually. We have Vanshika Agarwal who has sent in a question. She says, I am a single mom and I have a 2-year-old daughter. I am currently employed and the only source of income in the household. I received some pension money and also the investments that my husband left behind for us post his death. Now she has 2 questions. First, can I invest, how can I use this money for my daughter's future? And the second question is, my relative told me about child plans. Are they any good? And it's the very same question that I asked you. What's the difference between these child plans and a regular mutual fund? Tough times, of course, for Vanshika. She's the sole earning member, and I'm assuming her family is only her and her 2-year-old daughter.
2-year-old daughter. So the most important thing Manishka should do is take adequate term insurance.
Okay.
And do very good documentation. We spoke about documentation. Husband and wife both are there. If one dies, we are assuming at least the other parent knows.
Can handle.
In this case, there will be no parent. So if something were to happen to Vanishka, the kid is going to be, you know, left alone. So documentation is very important for Vanishka. Vanishka should find a sibling or a parent. She must be very young. If the kid is 2 years old, her parents could be around. Her sibling could be around, or somebody whom she can trust. She sits with that person, does the proper documentation. That is step number 1. She takes adequate term insurance for herself. She is earning money, she'll get some term insurance. So that the bigger corpus is created for the kid. Does she need a child plan? No, she does not need a child plan. But if she doesn't understand mutual funds, etc., it's okay to take a child plan, because a child plan will do what a child plan should do. There are other funds which could do it more efficiently perhaps. But this won't do a bad job. So
is there any difference in the returns? I mean, when you say
it should not be there. It should not be there, but the cost could be higher. So therefore, the returns could be lower. And there could be some kind of a lock-in. Then you could say only the child can remove it, the parent can't remove it. You don't want to do those. You don't want any of those restrictions if you understand it. A simple term insurance, a simple index fund is enough. But if she's the one person who can't understand all this, first is she has to make a will. She has to have proper documentation. She has to put a good executor, which ideally should be her friend or her sibling or her parent, somebody, so that the kid has got another 16 years to attain majority. So she needs to do all this, because one parent has died, the other parent, if something happens, the kid is... I mean, the kid is going to be alone. He could have a lot of money, but the kid is going to be alone. So the person to look after has to be appointed. All those documentation first, term insurance, and then money in a mutual fund. If you don't understand, child plan is good. If you understand, an index fund is enough.
Okay. 3 steps. Documentation, then term insurance, and then finally, of course, mutual funds or a child plan. Both will serve you the purpose. A child plan may be a little more expensive, but like Mr. Subramaniam said, it's really just a 19-20 odd difference, so it really shouldn't matter. And if you yourself don't have time to sit and track your mutual funds, the child plan is just a more convenient way to help you achieve the same goal. So we hope, we have been able to answer Vanchika's question. All right, next up, and once again, let me remind all our viewers, our phone lines are open. Do call in and we will get your question answered right here with Mr. Subramaniam. Okay, Neeli Avinash has sent a question. It's a very relevant one because it's something that we've been discussing, that what happens after the investor's death. He asks, how can a nominee claim the units / corresponding money of a mutual fund portfolio when a owner is deceased? What are the steps for the same? Does the nominee need to redeem the units as part of the claim instead of transferring to his or her own portfolio and redeem the same when he or she actually needs it? Now, his only concern is no one wants to redeem the mutual funds when the market is in a beaten position. But Mr. Subramaniam, when you actually are a nominee, why do you need to redeem the mutual funds in order to transfer it?
Okay. It's like a bank fixed deposit. Okay, it can be transferred. Shares can be transferred. A bank fixed deposit has to be redeemed and it has to be reinvested. So here the money will come to you and then you have to reinvest it. What does a nominee have to do? Really nothing. Nominee should have his KYC done. So the investor had his KYC done, therefore he had invested.
True.
Or maybe invested in 2002 when there was no KYC. That doesn't matter. But today the investor is dead. So the nominee should make sure that his KYC is done. He should go to the place, show the death certificate and have some proof that he is the nominee. So which means his PAN card, address proof, etc. That's fine, but it will be redeemed and he will be paid the money. And he has to reinvest it. Now, not redeeming when the market is low sounds very stupid because you're just taking it from one pocket and putting it into another pocket. So you're redeeming it from Mr. A and it is going to say Mrs. A. So you're redeeming 1 lakh and you're investing 1 lakh. So it doesn't really matter whether you're redeeming 10 lakhs and investing 10 lakhs or whether you're redeeming 1 lakh. Nothing is changing
buying it back
on the same day.
Right.
So the money is coming into, let's say Mr. A has died, the money is coming into Mrs. A. On the same day she's investing in the same fund at the same unit price. So it doesn't really matter. Only the name is changing. But the procedure is the money will come into her account and she will have to reinvest. But if the nominee is the second holder, then nothing happens. As the first name is deleted, then the units remain there. But if it was a single holder and a nominee, like say Mr. A and Mrs. A, then Mr. A has died, the money will be redeemed, it will go into Mrs. A's account. Mrs. A will have to issue a fresh check and invest in her name. If the procedure is simple, market position doesn't matter. Whether the market is at 30,000, 40,000, 50,000 or at 10,000 doesn't matter.
Okay, all right. Unless Mrs. A, does not buy shares again on the
same day, same unit.
Only then it's a problem.
Only then it's a difference.
Yeah. But otherwise, I mean, you're getting the money, just put it back into the same units. It shouldn't make a difference, honestly, whether the market is down or up. Okay, I think we have a live caller, Mr. Mahendran from Chennai is joining us on the phone line. Do we have him?
I am Mahendran.
Hi, Mahendran. Hi. Tell us your question.
I am 55-year-old senior citizen. I have invested in mutual fund by retirement corpus, say about 20 lakhs.
Okay.
And I said I want to get reinvested up to 2023, another 4 years. So this 20 lakhs, I will use a split cap. This is Kotak Standard Multi-Cap 5 lakhs, AA Asset India Large Cap 5 lakhs, and ICICI through Balance Advantage Fund 5 lakhs, and Mary Asset Emerging Blue Chip 1 lakh, and HDFC Small Cap 1 lakh, and ABSL Frontline Equity say 2 lakhs. Of late, I found this ABSL Frontline and Balance Advantage Fund is not doing good.
Very well. Yeah.
So I want to switch over. My goal is that after this 4 years of investment, I should get every month say 3 lakhs 3,000 rupees, 36,000 rupees every month.
36,000 every month. All right. Okay. Yes. This is after 4 years.
After 4 years. Yes.
Okay. All right.
That will take care of my.
Your expenses post retirement.
Yes.
Okay, all right. It's a lot of funds that he owns at the age of 60 plus. I don't know if you got all the funds roughly, but I think at least you got the mix basically. So what do you think? Will it serve the purpose?
It's very scary to note that you've got just 4 years to go, and in 4 years you're expecting equities to do well. Yes, I am also expecting it to do well, but largely when I take a call on equity, I take a much longer call. Maybe 10 years is what I would like to take a call. So yeah, this is too short a period. The market is down, so it could go up, yeah, but it could stay here for next 2-3 years, and that could put more panic in your head. So if you want the money in 2023 from equity, 2021 is the time when you withdraw. So you actually have only 2 years to go. I would not put so much money in equity. I would have some money in debt. Secondly, when you're investing about 25 lakhs, you're much better off asking an advisor, because the funds you have picked are not bad, but I'm not sure whether it is absolutely appropriate for you. For example, Birla Frontline, it's a good large cap fund, perfectly all right, but large caps have done well, then it has done badly, and so, you know, they will fluctuate. Then you picked up some small cap funds, and you have got 4 years to go with a small cap fund. I think the risk is very high. You have taken the slightly higher risk portfolio. I do not know the other parts of your portfolio. If all the other things are in debt schemes, then I'm fine. Let this money should remain there. But to be able to create a fixed income of say 36,000, you cannot be in equity. For that, your money will have to be in a debt fund, and you will have to do a systematic withdrawal plan. So I think you should seek better advice and learn a little better. And put more money in debt schemes. 4 years is too short for an equity scheme. I would be a little worried with this portfolio. Extremely aggressive portfolio. 10 years, I'm happy to take a view. 4 years, I find it difficult to take a view for.
Yeah, like we said, you know, the longer this thing, the time
15
horizon.
years, 10 years, then equity is okay.
It's better.
All these funds are good. There's nothing wrong with the Mirai or an HDFC or an ICICI fund. But the question is, it's not appropriate for you, perhaps at this stage.
Okay, all right. But with that, we are completely out of time on this segment of Ask the Money Show. Mr. Subramaniam, it's always a pleasure having you with us. Thank you for patiently answering all the questions and queries. Well, folks, like I said, it's always expensive to have a child, but just be financially equipped for it. And don't forget, you have time on your side, and that usually does help you save up very well for your child's future. Speaking about child's future, now is the time when your child may be mulling an education abroad. Do you know the kind of costs involved? Well, it's quite big, let me tell you that. So be prepped for that, because next year, in all probability, your child may decide that he wants to go abroad. In fact, he may be taking his flight out. Now is when you should be wary of all the costs involved. Welcome back. You're watching The Money Show on ET. Now, we told you about how much it costs to raise a child. Now, know how much it costs to send them abroad. And believe me, that too is a very big figure. So to talk about that, I've decided to bring on board Anshuman Mishra of Loan Adda, which not only, of course, is an online new age loan and lending portal, but Anshuman himself takes a very keen interest in advising students who wish to go abroad. Anshuman, thanks so much for joining in on ET Now. Nowadays, of course, it's a fad, whether you're a graduate, whether you're an undergraduate, to go abroad and study. But the question is, while there are various options out there from America to Europe to UK, you know, what exactly are the sort of costs that are entailed? If you could categorize it for us.
Mubina, the first thing you are seeing right now is that if you talk of an undergrad education, as the US calls it, or graduation as we call it after 12th standard, so US is the primary destination. And being number one, the costs are also high. So it costs on an average for a 4-year graduation course to do 1 to 1.5 crores in the 4 years, which includes the living costs, the tuition fees. So typically on a annual basis, you have a cost of 22 lakhs of tuition fees, and around 9 lakhs you can add on living expenses. The second most destination which students want to go is the UK. So UK has slightly lesser cost. So that costs around 60 to 70 lakhs for the 3-year course, because UK has typically 3-year courses. The third joint rank is between Canada and Australia. So what happens in that is, in all these 4 places, there are some ways that yes, it costs a high amount, But you can do two things essentially to reduce those costs. One is that there are some ways and tips that we can give students to reduce the overall cost, and second is a scholarship. So we will talk about that in when you ask the next question actually.
Exactly. But Anshuman, apart from, of course, tuition, etc., there are also, of course, other expenses. And I'm talking about living expenses. I'm talking about, even for that matter, every time the child will come to visit his or her parents back home in India. From US to Germany to Singapore to Australia, roughly how much of the total education cost actually goes into the other ancillary costs like these?
See, the US costs on average, $1,000 a month to live in. That's around 70,000 INR. If you take UK, it's slightly more expensive. You can take, 85,000 Indian rupees per month. Australia and Canada is slightly, cheaper. Now, the thing is that the average Indian student comes back once every 1.5 years. Now, if you start coming back more, or if you, have a very frugal life as compared to what the students can have otherwise, you can reduce those costs. So if these living tuition costs are bifurcated into an individual's ability to live life as a student, because a student's life during that time you have to focus on education because it's quite expensive. Unless you take a Germany or a Ireland, which are new age places where tuition fees virtually become zero, it's just living cost. But otherwise, if the destination is US, where most of the students want to go, or UK, where they want to study and then hopefully work in, you will have to ensure that these overhead costs like your visa costs, your travel costs, your one-time costs like your dormitory costs, which are sometimes taken for the whole semester, on some colleges take for the full year. Then you may want to think that, okay, do I want to go to an Indiana, which is very, very cold, or do I want to go to the East Coast? So these factors affect the parents, and most of the time the parent has to decide this, because one of the most important factors is not the country, but the college. So the parent and the child are today at sea to think of what kind of colleges you go, because it's just not your college. It's your course that you want to decide. Within the course, what kind of electives you want to take. All of these factors, affect the cost. So essentially that these costs are not fixed. They can, skyrocket. But at the same time, you can manage them by, say, taking a loan or taking some exams like advanced placement test.
Fair enough. Anshuman, when we talk about, of course, it being the parents' headache, of incurring these costs, let's also talk about education loans. I mean, now, of course, you have all these instruments out there in the market to help ease off, of course, the parents' burden. So how exactly is an education loan viable? What are the average interest costs as well? Because if an education loan falls under a personal loan category, that means the interest rate is usually a bit higher, isn't it, Anshuman?
See, this education loan is on an average cost between 12 to 14% in Indian, if you take it in India, of course. What happens in this case, in education loans, there are two advantages as compared to taking a mortgage loan against property loan. That for 4 years or 3 years, whatever the time that you're taking the loan, you don't have to make any repayment. So basically, the repayment starts either 6 months from the time you get a job after the course, or 1 year after the course, whether or not you get a job. So when that happens, along with that, you have an ATE. So you get income tax benefit under a section. So yes, it is 12 to 14%, but the other option which parents do see, that if you want to reduce your costs, so property has to be taken. Now, loans today for education can be given to the tune of 50 lakhs, even a crore. But you have to understand that this debt burden, now you have to essentially see that 4 years of education, and then after that, if you're paying it for say 5-7 years, is a 12-year tenure. So even if you're taking it for 12 to 14%, that's a huge outflow. So compared to that, the other option that happens for parents is that how can you take a loan against property at a lesser rate? Now loan against properties are sub 10% for that matter as compared to education loan. But yes, if you are trying to go to US, you should think of an Ivy League and a good college. That will cost you around average median of 1 crore. In that, if you take 40-50 lakhs of a loan and then 40-50 lakhs, because you have to understand that you can just break up your costs, because you don't have to pay this entire 1 crore in the first year. There are 4 years for you to, earn and give that amount. Of course, the loan can be, scheduled. So do not send your child to the US or anywhere without tying up the entire resources. That's very, very risky, because there are instances of children which they cannot, do some part-time work or something. So please ensure, for the safety and security of the children, you do a financial closure. So for the child, yes, if you're sending to, UK, yes, you should have 50 lakhs. If you're sending to the US, you should have 1 crore. If in case you're now sending to post-graduation, suppose you're going to London School of Economics, okay? So after graduation, if you're sending, that's a 10-month course. So that costs around, 30 lakhs for 1 year. So that can be much lesser, but come what may, whichever place you decide to go, do not just send the child with the money in hand. Ensure that you know that there is a fair amount of visibility in the next 6 months to 12 months, what amount of money can come, so that the child can focus on the education and does not have to run around for funds locally around there.
All right. You know what, Anshuman? Unfortunately, we are not going to be able to extend our conversation anymore. We are out of time. So thank you so much for all your golden words of advice. It was very interesting when Anshuman said that if you tie all your resources together, also look at the payback period as well. Because when you're sending your child for an abroad education, it shouldn't be that he or she has spent all that money and then the degree is useless. Okay, well, on that note, let's move away from that, and as promised, let's talk about the TMS Savings Challenge. We told you, share with us some innovative ways of how you are going to save money. You did so, and now it's time to feature some of the most innovative ideas that we have received. Some of them, of course, were really, really funny, but unfortunately, we had to pick just 3 of them, and that's who we have picked today. So let's get straight to our very first candidate who has managed to save money. And remember, we are not talking about the quantum. We are talking about how innovative you have been when it comes to saving your money. So the very first debut will be appearing for you on your screens in just a bit. First up, it's Monica Waldia. Now, how has she saved money? She tweets to us that the love for cheesecakes can be pretty expensive, but not if you buy it on World Cheesecake Day. On this day, she bought cheesecakes only for 100 rupees, which, well, usually to my knowledge, cost more than 200 rupees. So I think she managed to hold her temptation and bought it on World Cheesecake Day. Not just good for her wallet, but also for her health. Farah, meantime, writes to us, and Farah, by the way, is a TV actor, and Farah says that as an actor, she has to take a lot of care of her skin because it's exposed to makeup every day. But instead of buying all these expensive face masks and face creams from expensive stores, she simply goes DIY. That is, she makes her own masks and applies it at home. And finally, here's one of the smallest savings that we have received, but we truly appreciate the effort. Hussain says that he managed to flash his student ID card at a sugarcane juice center and managed to save 3 rupees. Well, he's just a college student and it's a very small saving, but hey, it's the thought that counts. To all 3 of you, congratulations and thank you for taking part in the TMS Savings Challenge. Remember, folks, all of you too can take part over here. All you have to do is share with us how you have saved money on Twitter, on Instagram, and you as well can be a part of our wall of fame. Send it to us. We will tag you on our social media handles as well, and of course feature you on The Money Show. For now, it's a wrap. Thank you so much for watching and have a lovely long weekend ahead.